In the early 2000s, Enron seemed like the perfect success story. A billion-dollar company full of innovation, adored by investors, and celebrated on Wall Street. But behind that shiny image hid a web of lies, manipulation, and pure greed. This is the story of the Enron scandal, how one of America's largest companies collapsed, taking thousands of lives down with it. It all started in 1985, when two energy companies merged to form Enron Corporation, headquartered in Houston, Texas. Under the leadership of Kenneth, Enron grew rapidly. They began as a traditional gas pipeline company, but they wanted more. Their goal? To revolutionize the energy industry. And they did, at least on paper. Thanks to new deregulation laws, the U.S. energy market opened up to competition. Enron took advantage of this by trading energy contracts, buying and selling them like stocks. And that made them rich. By the 1990s, Enron was one of the most admired companies in America. Magazines called it the most innovative company in America. 6 years in a row. Its stock soared, employees became millionaires, and Wall Street was obsessed. But few people realized that the numbers behind this success were largely fake. To understand how Enron fooled everyone, we need to talk about something called mark-to-market accounting. In simple terms, this allowed them to record potential future profits immediately, the moment a deal was signed, even if no money had actually been made yet. Imagine signing a 10-year deal that might earn you money someday. Enron would instantly record that entire expected profit as income today. That made their financial statements look incredible. But when reality didn't match the numbers, they had to hide the gap. To hide those losses, Enron created hundreds of shell companies, known as Special Purpose Entities, or SPES. These entities were used to move debt off Enron's balance sheet. The profits stayed visible, but the debt disappeared, buried in a maze of fake partnerships. It was a perfect illusion of endless success. The mastermind behind these complex schemes was Jeffrey Skilling, Enron's CEO. Skilling believed that markets were self-correcting, that if you pushed hard enough, success would follow, even if you had to bend the rules. Under his leadership, Enron became a high-pressure, cutthroat workplace. Employees were constantly ranked, and those who didn't perform were fired. Then came Andrew Fastow, the chief financial officer, the financial architect. Fastow designed the SPES and used them to shuffle money around. He even personally profited from his own secret partnerships, earning tens of millions of dollars. And no one at Enron said a word. Why? Because everyone was making money, as long as the stock kept rising. In 2001, the cracks began to show. Analysts started asking a simple question. How does Enron actually make money? And no one could give a clear answer. In August 2001, Jeffrey Skilling suddenly resigned, officially for personal reasons. Soon after, the truth began to surface. Journalists uncovered billions of dollars in hidden debt. Enron's financial empire was built on accounting tricks and deception. The stock price, once above $90 a share, collapsed to less than $1. Thousands of employees lost their jobs and their life savings because their pensions were tied up in Enron stock. In December 2001, Enron filed for bankruptcy, the largest corporate bankruptcy in U.S. history at that time. The Enron scandal sent shockwaves through the world. Kenneth, Jeffrey Skilling, and Andrew Fastow were all charged with fraud and conspiracy. Fastow pled guilty and cooperated with investigators. Skilling was sentenced to 24 years in prison, later reduced, and Kenneth died before sentencing. Enron's accounting firm, Arthur Andersen, was also destroyed. They were accused of shredding audit documents to cover up evidence. Once one of the world's Big Five accounting firms, Arthur Andersen collapsed within months. In total, more than 20,000 people lost their jobs. The scandal led to major changes in corporate law and accounting practices. The U.S. government introduced the Sarbanes-Oxley Act, a law designed to increase transparency and accountability in financial reporting. But beyond legislation, Enron became a cautionary tale, a symbol of unchecked greed and arrogance. It wasn't just a financial disaster, it was a moral one. Enron wanted to be the future of energy, but became the face of fraud. A reminder that even the biggest empires can crumble when built on lies, and that if something seems too good to be true, it probably is. Thanks for watching. Subscribe for more stories about financial scandals, power, and the human side of business. Did you enjoy this video? Leave a like, subscribe, and tell me in the comments which corporate scandal I should cover next.